Well, hello to all of you. Wonderful to have so many of you online, and we've had such an amazing series. And believe it or not, we've come to the last Tuesday of October. Can you believe it, Lee? It's been quite a roller coaster of a month.
It has been a powerful month, and yes, can't believe that we are heading into the second last month of the year, and our Wealth series is coming to a close.
Oh, it's brilliant. Well, Garth, it's wonderful to have you online, and thanks so much for coming online tonight and sharing your wisdom. And I look forward to, everyone can see the title there, How to Create and Preserve Your Wealth Offshore, plus everything tax structuring and how to best future-proof yourself for 2020 and much more. I want to go into that. So it's quite hard to put it into a topic, quite frankly. But no, Garth, it's wonderful to have you online, and we've known you for a long time, and we love it when you share with the community. We always get amazing feedback.
Oh, evening to everybody. I mean, fantastic to be involved in Wealth Migrate again. Always enjoyed sharing the topics, and I think they're very pertinent, and it's a great time to be talking about the subjects. So yeah, I look forward to chatting to the guys tonight and seeing what we can do for you.
Awesome. Well, thank you very much. And if you can or can't see, I'm wearing my Springbok top. So if you don't know anything about rugby, it's the final of the Rugby World Cup on Saturday, and the Springboks are playing England. So although I should probably be sitting in some corporate jacket with a corporate tie, this week is about supporting the team in terms of where we're at. So before we get into the Q&A, I just wanted to remind you all, we've been talking a lot about Wealth 5.0. The Japanese came out with the concept Society 5.0. Roger Hamilton came out with Entrepreneur 5.0. We adapted that into Wealth 5.0. As we go into the new decade, there's some very exciting times ahead of us. But it's really important that you understand what this is. And it's based on 5 different components. You've got your impact, you've got your creativity, you've got high touch, you've got high tech, and it's all about digital and problem solving and future proofing. Now, if you've been on the previous webinars, I've gone into this in a lot more detail. We're going to go into this in a lot more detail at the breakfast and on the Wealth Weekend. So I'm not going to cover it a huge amount today. What we've basically been doing over the last month, we started off on the first Tuesday of the month with the 5 secrets to offshore real estate investment success. Now, if you go to this link, you can see it in the top right corner there. You can actually go and get the recordings. If you haven't actually seen these webinars, or you want to go and look at these webinars, I took people through how do you get the best information? Where do you find the best research? How do you find the best partners? What are the best opportunities, particularly in commercial in England, Australia, and America? How does financing offshore work? And most importantly, how do you build a good team around yourself? Then the next week, we looked at how do you immigrate overseas, both financially and physically. What is it about getting a first world passport? We spoke about real people that have actually gone out there and done it. We've spoken to immigration agents about the different countries between Portugal, Cyprus, America, England, Australia. We also spoke about what it takes to financially immigrate and or physically. And then most importantly, we spoke about what it is to become a global citizen. Last week, we had an amazing webinar. We got incredible feedback from people around Hilda Lunderstedt. Now, we talk about real people and real stories. Well, she is a true global citizen. She built her business. She sold her business. She's invested in global real estate and businesses, and truly now has immigrated to America and truly epitomizes what it is to be a global citizen. And she shared some amazing secrets and lessons with people last week, and I do highly recommend that webinar. And tonight, we're really excited and very grateful to have Garth online. And what we're going to be looking at tonight is, Garth advises and works with some of the wealthiest people in South Africa and the wealthiest families. We're going to be looking at some of the strategies that they're doing around creating and preserving wealth. We're going to look at diversification and how you build balanced portfolios, what it is about tax and structuring. Where's the future of emerging markets, places like South Africa and elsewhere? What is happening in the global economy? And if we start looking 2020 and beyond, what can we actually do to not only survive, but thrive? And if you've enjoyed this series, I really ask you to go out there and share it with your family and friends. We make these recordings available to people. I believe that it's all about the knowledge. Today we had the privilege of presenting to the South African Reserve Bank and the South African regulator, the FC, the FSCA. Yes, and we spoke so much about, it's about sharing knowledge. Sorry, was someone saying something? I learned a new acronym. They call it FISCA, which I hadn't heard before. And And then, you know, later in the webinar, we're going to talk about the offshore breakfast that we're going to be holding. They're quite soon now. They're 2 weeks away. We're doing them in Durban on the 12th of November, Cape Town on the 13th of November, Johannesburg on the 14th of November, and Pretoria on the 15th of November. And this is going to be really, really exciting. You know, we've been hosting these events in South Africa since 2007 without being sort of, you know, arrogant. We really put these together where people could come together, they could learn the knowledge, they could get access to the partners, and they would be able to make the right decisions for them and their family. And then we're going to talk about the Wealth Weekend, where we're actually going to be going a lot deeper. You know, what Hilda spoke about last week is it's all good and well to know the theory, but the weekend is where people will be able to immerse themselves and walk away with a plan. And what's really quite interesting is that the metaphor we used was it was like getting a learner's license. You know, when you go and do your learner's license to drive a car, you learn all the theory and you go and write a test, but you definitely can't drive a car. And yet when you go for the weekend, it's like doing your driver's license. It's about actually getting in the car and leaving with a plan for 2020 and beyond. And so without further ado, what I want to do tonight is actually move into our webinar in terms of where we're actually going. I remind you of what we've been through on all the different webinars. It's critically important that you get clear on your why. Most people are always trying to figure out their how and their what. But if you don't get clear on your why, you'll never get to where you want to get to. You've heard my story. If you haven't, go and watch it from the first webinar, both about my dad and about my uncle, and you will understand very clearly why we do what we do as a platform and why we get guest speakers like Hilda and Garth to share with people so that they could learn and grow. I want to share with you this little video, and I think it'll probably be better to play it through here. And some of you might have seen this video, some of you might not. It's a recent video that we've had updated, and I believe that it really summarizes why we do what we do. You should all be able to hear me. I just want to check that you're seeing the main screen again. Great. So I remind you of what this webinar is all about. It's about freedom of choice. You know, what we're passionate about, we don't mind where people live. We don't mind where they invest. We don't mind, you know, what they do is their day job. But what we do care about is that they've got freedom of choice to choose where they live, to choose where their kids go to school, and ultimately to make the decisions they want for their life. You know, it's about peace of mind. It's about preservation of wealth, and it's about Plan B. And without further ado, I wanted to get right into the topic of literally asking Garth the questions that we've got prepared for him. But while we're doing that, why don't you write down, why are you here? What do you want to get out of this session with Garth? And if you've got the little chat box, if it's your first time to a webinar, literally go up in the top right corner. You can see that there's a little box there. And if you just type down what it is you want to get, because I've got some questions, you know, I've worked with Garth for a long time. I've got some questions. I'm fascinated by what he thinks, and we haven't choreographed this in any way, so it's fascinating to hear what he, you know, to hear what he says. Sorry, can you guys hear me? Someone's just saying they can't hear me. You can?
Yep.
Yep. Okay, great. So just type in there what you want to hear. But what I really want to do also is that what I love about Garth and other people like Hilda, etc., is that we keep coming back to real people, real stories. You know, it's all good and well to learn the theory, but let's get into the practical, because that's what helps people really be able to take, you know, control of their own lives. So Garth, from your perspective, what is your story? You know, before we get going and we get into detailed analysis of portfolio and balancing and global economies, what's your story and how did you get into this space?
Okay, so first of all, I mean, if anybody thinks this is pre-prepared, I literally landed yesterday afternoon, and I spoke to Scott about 5 minutes before this started, so it is totally as it comes off. my story, yeah, look, I think like most people, you know, started off very early on in the financial industry. I sold my first business at the age of 24. And it was very interesting. I had a great financial advisor at the time that was looking after that business. And, you know, I was quite intrigued by the industry. And I realized at that point that I had not enough, you know, formal qualifications other than a BCom in the finance side of things, and became fascinated with this financial industry and the intricacies of it. And I think that was the start. And I built a business in the finance game with Liberty Life and Stanlib for a period of 10 years. We sold that business, and then I did a short 4-year in Sasfin Private Bank working with the high net worth there, and really built the foundation and the skeleton of Callio Capital, which we started 2012, broke away with my partner, Nick Needman. And yes, we built from there, becoming a multi-family manager, a multi-family office looking after, 65 to 100 super high net worth families, depending on where they are around the world at the time. So yeah, that's the story, short and sweet.
What's just interesting for others, and I just want to point that out for people, is that one of the things that I've learned is the fastest way to get successful is to copy successful people. And when I studied it, most people around the world don't know what a family office actually is. And yet when you go and look at what the wealthiest people do, they all have family offices. So would you mind just explaining a little bit more around what a family office is? Because most people have never even heard of the concept, to be frank. And yet, all the wealthy people have them. So why don't we all have one?
Yeah, I think a family office, it's a difficult thing to understand, but to break it down into a simple thing, I mean, a family office is effectively the architect of a home, but the architect of the finances. So they'll put together a blueprint from start to finish of all of the financial intricacies of a family. And that can be the risks of the family, the estates, the legacy planning, every single issue involving the finances. So a family office becomes the architect and then employs various professionals, investment advisors, seeks private equity opportunities, and looks after the family as a personal financial director. So the family office is sourcing opportunity, protecting, preserving. But most importantly, I think probably the word you spoke about earlier, I mean, to bring it into modern day language, it's really creating the collaboration between all of the parties and all of the individuals involved in the finances of a family.
Sure, I've never heard it explained like that. It's a wonderful description of how it all comes together. So for those of you who don't have a family office, either put it on your goals as something to achieve, or find a way to do it. And I'll talk a little bit about that a little bit later. So what I want to do is, you mentioned, Garth, that you're dealing with sort of 65 to 100 high net worth families, and I wanted to know, what was your secret sauce in helping people not only get wealthy but protect wealthy? Now that's not necessarily just your secret sauce in terms of helping them, but also what you see. Again, one of the things that I've been privileged to do is by working with wealthy people. I'd often joke I'd have to be a bit of an idiot not to spot the trends. So what do you see as a couple of the secret sources that are coming through that where people are creating wealth and protecting wealth?
The biggest thing is, for a lot of the entrepreneurs who build a business and go out there, I mean, one is this recognition that entrepreneurs are not necessarily great investors. I think that's one of the key things that Callio has brought to the high net worth, the high net worth market. The unbiased, assessment of the world markets and the unbiased provision of service providers to that market. And that is critical. I think too many people think entrepreneurs are great investors, but there's a vast difference between a Richard Branson and a Warren Buffett. The one is an investor and the one is an entrepreneur. And the entrepreneurs have become a lot more in tune with the behavioral finance and the weaknesses that they have when they go out there into the investment market. And it's actually that strength that we've brought to that weakness and that collaboration to actually bring correct behavioral finance, good investment principles. Entrepreneurs they're strange creatures, because they take 10 years, sometimes way longer, to build a business, yet are very impatient with investment. And they also tend to have this belief that, you know, everybody else out there is like them and going to be an instant success and make money. So they're very prone to getting involved in, you know, investments that might not necessarily deliver the returns, and unbundling that, because they only reflect their own personality into those businesses. So I think, you know, when we talk about secret sources, you know, one is there's a lot more consciousness around behavioral finance. There's a lot more research available. There's a lot more bad news and good news and white noise and, you know, social media. So the habits of people have become a lot more influenced by this. So controlling that behavior is one of the significant things that we add to that relationship, being able to constantly, you know, actually go through the mood swings that these people face when the markets go up and down. So, you know, also the global hemisphere has changed so much. You know, you've had massive amounts pushed into the markets, and you've had these people, you know, running the Fed and running, you know, the European central banks, pushing this incredible, you know, stimulus into the market. So people have become, I think, you know, almost flooded with opportunity. And by being flooded with opportunity, and with the world being in this place of like incredibly cheap debt, you know, it's quite risky out there. So understanding how to create structures and how to create investment opportunities that are assessed on true merit becomes a much more difficult thing in today's environment, with the flood of opportunity and the flood of information. So yeah, I think one of the most important things is correct structures, correct timeframes around investment, you know, putting square pegs in square holes, and building a sustainable portfolio which can control the behavior, because that's the biggest thing, and constantly explaining that plan. And, you know, as I said, the architectural blueprint, you know, keeping people on the course. They're very easily distracted from the objectives. And I think that's probably one of the biggest secrets to successful investing and even building a business is having a very clear focus and achieving that outcome by staying the course on it.
That's wonderful. It's it's such valid information. You know, I always say to people when they're brand new entrepreneurs as well, always, it's so funny, they leave the corporate world and they come out and they want to do, you know, 20 different things. And I always say, pick one of them and just, you know, get focused. And I speak from experience. I made the exact same mistake. It's amazing how people struggle to focus. And you know, I always say there's no investment out there that's going to get you wealthy. Yet it'll be your habits that get you wealthy. And I love what you said here in terms of staying on the course and, you know, having that clear focus. So I want to understand a little bit more about this. And, you know, I acknowledge that tonight's just a webinar, and I presume that there's a lot more deep analysis to this. But people talk, and sort of the more sophisticated people talk about having a balanced investment portfolio strategy. Firstly, what does that mean? And you can see I've just got some pictures up here. So I'm not just saying in the equities market or whatever. I actually battled to find pictures of a balanced portfolio, I'm not going to lie. But what does it mean in terms of a balanced portfolio, and more importantly, you know, what should someone be doing around it when it comes to strategy?
Yeah, I think a lot of the rules have been broken there, Scott. I mean, I think people need to, you know, take stock of what happened since 2008. And I think the traditional balanced portfolios where, you know, your aggressive portfolio was defined by how much you had at risk and how much you didn't have at risk. So you had 80%, you know, technically in equities and 20% in bonds. And asset allocation designed these traditional portfolios based on how much equity you had. I mean, that was a real distinguishing factor. And a balanced portfolio would be 50% in equities, 50% in bonds. And you would adjust that asset allocation depending on the markets being expensive or the markets being cheap. I think one of the most critical things that has changed is the playing field is not necessarily the same. And a lot of the focus has changed towards diversification and time allocated towards different investments to create a balanced portfolio. And that is critical. And, you know, just to elaborate on that, you know, I spoke earlier of the time frames around it. So a balanced portfolio for me would be understanding first and foremost what you have. Now, if you're dealing with a high net worth individual, I mean, the first thing the person has to understand is what is the purchasing power of capital in a traditional sense. What return in percentage-wise does a portfolio have to receive or attain to sustain what a person's lifestyle is? And a lifestyle is collectively travel and everything that you've got. So that's the first thing you've got to work out. But then you've got to actually look at how to create a portfolio that can sustain the volatility of markets. And that's when we start looking at the real creation of a balanced portfolio, where you can enter a realm of different investments without having to draw down on those investments at the wrong time, that they allowed the time frame to deliver returns. And I think that's the difference. You can't work on the traditional, here's equity, here's bonds, here's cash, here's property. I think people are, A, able to get a lot more information. B, I think and I say this with due respect, I think the quality by and large, since 2001, the quality of advisors today is a far cry from what the advisors were previously. And I think that's important, to establish with somebody that can speak your language and understand your goal. Because a balanced portfolio.
Sorry, when you say they're far cry, are they better or worse? Are advisors better or worse?
Advisors are significantly better, significantly more informed, and significantly more qualified just by the change of the legislation. I mean, there was a time that the advice you were getting was really dangerous, and that didn't speak to the whole industry, but there was a massive cleanup in the industry. So I think, these days you can really partner with a financial advisor, you can partner with a family office, and you can really lay down what your balanced portfolio is. And the understanding of risk profiles are vastly different. Understanding risk profiles, it's a much more exact science. And, a lot of the guys in the family office today are employing and spending a lot of their research actually on the psychology of money. And, you can go back to your whys, your whats and that, but that also applies to your portfolio. I mean, people want to attain wealth, but they often don't know why they want to attain wealth or what it buys them. So the same thing comes when you start, structuring a balanced portfolio. What risk do you actually have to take is the first thing that you've got to ascertain. And there's this whole thing called asset liability modeling, which works on, returns above inflation to achieve results. And I just think people should break out of that traditional mold and really spend their time consulting to get to, why does my portfolio have to be balanced? Why does it have to be aggressive? Because it's actually what a person's lifestyle has to be, is dictating what the returns have to be. And, when we work with a lot of people, these are super wealthy people, and their attitudes are different to the person still acquiring wealth and who is younger, and, there's multi-generations. So our job is a lot more complex to define a family's risk profile. But a traditional balanced portfolio is not the pie chart that you see, or the traditional balanced portfolio is not what you see today in terms of just the equities, property, fixed income. Each one of those asset classes you're illustrating there has got a total analysis on its own, whether it's extremely conservative in the fixed income space. You've got a lot of sophistication in protected equities today, where you can take risk with determined downsides and all sorts of things. So, I think there's a lot more consulting, there's a lot more psychology around money to define what a person's balanced portfolio is. It's not one size fits all at all anymore. Even though you can follow the traditional guidelines, I don't believe that's what's going to dictate wealth or preserve wealth going forward.
And if someone wanted to create a balanced portfolio for them and their family, you said partner with a financial advisor, find a family office. Is there a good book or something that they can read, or some, is there a website they can go to, or where would you start in terms of if you were sort of fairly fresh to this?
Look, I mean, there's such a wealth of information. I mean, just Googling recession will give you 10 million opinions on it. So let's talk about really good books. Number one, I think you should always look to the author that you're looking at. I think one of the best books I read for the fundamental grounding in investment and understanding the principles of it is a book by Ben Colston called A Wealth of Common Sense. And interesting guy. I mean, he traded every single derivative, every factor in the market, and all of these things, lived through 2 or 3 recessions. What I find fantastic about that book is he arrived at the conclusions that all people like myself who have been in the industry for a long time, is that most investors will never understand the sophistication they get themselves into. And it comes down to the averages. It comes down to the norms. I mean, you're a property expert, let's say, and Hilda, who I know very well. I mean, Hilda is particularly fascinated in the industry she made her money in. So everybody's got this expertise, but understanding the principles around averages. Let me make it simple. You're not going to do 14% as the S&P 500 has done for, I think, consecutively 7 years for the rest of your life. The developed markets had this very strong run. It's well above its historical averages. And developed markets are now, you've seen most of the wealth and most of the return in the developed US. Those shifts will always return back to balances. And I think when you look at a book like A Wealth of Common Sense, which is a great starting point, it deals with those averages. It deals with understanding the playing field. And if you don't understand the playing field, that's where the mistakes come from. People can't see bubbles arriving. They can't see discounts because they don't know what the historical averages are for those returns. They can't understand the time frames of new technologies coming in. There are these very quick and these, like instant wealth creations, but accessing that less directly doesn't mean, I mean, a great example, I mean, one of the guys that works for me invested very heavily in 3D printers. And as we know, it took 15 years from when 3D printers were first, conceptualized to when they arrived in the market. And even if you look at them today, they're clunky, they're messy, and they're still not quite delivering that. So I think it's very important to understand the playing field of investment. So that's a great book. I recommend that as a read for everybody. And I mean, there's a huge number of books I can put through, but I found that one the most pertinent. And from an author who's lived, slept, and actually breathed the industry. And I don't like reading, theory. I like reading people that have really been there and really done it.
So that was Ben Colston, Wealth of Common Sense. A couple of
Wealth of Common Sense.
Yeah, look. So I mean, if they're just I know I get the same thing when people ask me, for books. But I mean, any other 1 or 2 books that you would add to that, just while we're on this track?
Yeah, listen, I mean, if you've got insomnia, I mean, I think, from an investing point of view, if you can stomach something like Warren Buffett's Snowball Effect, 1 or 2 pages of the 900, page book. It's also, the Snowball Effect is a great book, I find. I think if you're a more sophisticated investor, it's great to see how the mindset of Warren Buffett works. I think you can take any recognized investor, any recognized entrepreneur, and read any of those books. I mean, all of them are going to provide you with a grounding. But I also think, not just reading historical books. I also think, just getting in touch with the factors that influence markets. I mean, people just don't read enough. They read the headlines and listen to the news, and those are the sensational things. But if you take the time to actually read what's going on in the markets and what's influencing it, you get such an amazing grounding, and you start tracking these things. So, for me, it's critically important that any person who wants to invest spends as much time actually equipping themselves. So, yeah, I mean, sure, I can't think of a huge range of books off the top of my head, but yeah, I mean, I can certainly provide a list of things that sit in our library.
I would be fascinated by that, Garth. I wanted to actually share. Sorry, I'm running off one screen here tonight, so I've got to jump around in a hotel room.
Yeah.
But I wanted to share. We actually put together our e-wealth pack. Where's it gone now? It's one of these ones, and where's it gone? Here's our e-wealth pack. Because I got to ask this question all the time, and I won't bore you people with all the other details, but actually put together a recommended list between the mind, life, goals, real estate, investment, business. So, I'd like to share this with you, and if there's any ones you think that we should add to it, I'd love to look at that. And for anyone that's coming to the breakfast, we'll give them
I'm seeing you scrolling through there, and I recognize a lot of the titles, and I think the Rich Dad Poor Dad series, a lot of those are very, very interesting. From a global perspective and understanding property, I saw a lot of the titles there. Richard Branson's always a good read, but a lot of those as well. There's a lot of those Awaken the Giant Within. Anthony Robbins, I think he's one of the great motivational guys that you'll find, and he's recently moved into truly understanding building portfolios and stuff. And we actually had some work historically with a robo-advisor, and I can't remember his new book, but yeah, also a great.
Unshakable.
Yeah, that's the one. Yeah, very good book.
So let's pivot now. And you were talking about balanced portfolios, and different people have different thoughts in terms of property, and specifically direct property. What are your thoughts on property as an investment class in comparison with some of the the other asset classes? I know that your investors have a lot of sophisticated investments, private equity, and a whole bunch of other names that you've already mentioned. But what's your thoughts in terms of property in general?
All right. Look, first and foremost, I think you must understand there isn't a super wealthy human being on the planet that doesn't have a significant amount of portfolio, held in property. I think property is the one asset class that, when risk is on, pays you to sit and be patient. So, when you're looking at the current environment, I think property remains a good investment, but you've also got to understand property is a complex asset class. You've got retail, you've got commercial property, you've got industrial property, you've got, medical property, multifamily, and I'm sure the listeners, being involved with you, will have a very, very good understanding of a lot of that. So property for me has that one underpin of dividends or rental income, which, even if the markets are moving sideways like they have been for pretty much, the last sort of 18 months, and you look at those markets and they spiking with volatility, that underpin of rental income remains an absolutely valuable, source. And you're sitting there, and you can get a rental anywhere from a lower capital growth portfolio, let's say from 4.5 right up to 8.5 on rental income. And even if the capital growth is not occurring, that underpin is giving you an advantage. So property is a significant building block of portfolios, be it direct property, be it through a portal like you offer. But yeah, I think you've just got to be very careful where you invest. You've got to understand your sectors. For me, you've got to look at like global demographics, understand that medical remains a great property investment by and large, whereas retail property and anything that's not sort of mainstream New York, your big main streets of the world, they can have major problems because these secondary properties and these smaller retail type properties that are not main street, or I worry about those because you're sitting with a very, very low interest rate environment, and at some point the world's got to start normalizing those interest rates. So when you see those interest rates going up, there's going to be a problem that those properties can't absorb those cost increases. And secondly, property remains a diverse asset class that can change form. So, as you see commercial retail property with all the online changing, a lot of those businesses can morph into logistic hubs and that for distributing online shopping and that. So it remains a valuable building block and probably one of the most stable building blocks. The other reason I love property and high net worth investment, in the family offices, why I love property, is it's the one asset class people never sell when it's down. Whether you're a direct investor, people are very prone to selling equities on the downward cycle, but they never sell property at the bottom. But yeah, you've got to be careful of your gearing ratios. You've got to understand and partner with the right people, and you've got to look at the factors of where we are in the global economy right now. But to answer the question simply, I think property is great. Understand your sectors, and it is a significant building block of your portfolio, both global and locally in South Africa. Yeah, anywhere in the world, understand that sector well there.
It's really interesting what you said. Some people have heard me talk about this, where I met a lady that was buying shopping centers in South Africa, and I said, "Are you not concerned that in America, most of the shopping centers going bankrupt?" She said, "Oh no, that'll e-commerce will never come to Africa." And I was like, "What?" Like when we were riding Volkswagens, cars never turned up, and then more recently, one of the biggest funds in England has lost a huge amount of its value, equally in some of the big shopping centers there. So it's just interesting, you've got to future-proof yourself with trends as well, in terms of where things are going. So let's look at diversification. It's interesting. You get all the different types of wealthy people and so-called experts that give their thoughts. And some people say diversification. I can't remember the experts. Maybe you can remember their names, but some people say diversification is you shouldn't do it, and actually it's by putting many eggs in many different baskets, it's actually a bad thing, and that you should really focus and put all your eggs in one place. And others say that diversification is absolutely key. Ray Dalio, who was one of the people that Tony Robbins interviewed in that Unshakable, diversification across assets, countries, currencies, within assets, etc. What are your thoughts on diversification?
Yeah, look, there's schools of thought which you've touched on there, but you can diversify to death. And what I mean by that, if you buy too many opposing asset classes, your net result will be a tug of war where your end result is zero. So diversification, understanding strategic asset allocations and the weightings of these things is critical. So you can't put all of your eggs in one basket. Entrepreneurs can have a single stock holding. Okay, they build a business. An investor has to diversify, but there's a fine line between there's a fine line between diversification and just throwing darts. So when I talk about diversification, I think you've got to understand politics. You've got to understand emerging markets versus developed markets. You've got to understand volatility of emerging markets versus developed markets, for example, and you've got to understand your risk. So you diversify first and foremost your portfolio based on how much risk you're prepared to take. So when we talk about diversification, you just take an asset class like equities and you put property into equity. Okay, that's diversification already. So as you look at low interest rate environments in the world, value becomes difficult. So you've got different styles of diversification. So diversification is practiced by everybody, but diversification to death by owning so many things that you actually don't have any significant value in any of the opportunities won't give you the result that you want. So when we talk about diversification, I'm talking about very basic emerging and emerging markets and developed market diversification that you should have, because they're cyclical and they shift from one side to the other depending on where the cycle is and how hard they have run. So one thing that people never know is when that's going to happen. So you've got to set parameters to diversify. So let's take emerging markets being cheap and developed markets being expensive as a guideline. Okay. Developed markets can carry on running and emerging markets can remain cheap for a while. But we know that change will switch at some point. So your weightings are incredibly important in diversification. We also know that the markets can trade sideways. There's been fears of recession. So you've got to diversify to start preparing your portfolio for something possibly like that happening. This is where we talk about time-based investments. Diversification into capital that's protected over 5 years, diversification into investments that have an expected time frame of 7 years to deliver, and most property and most equity, if not given 7 years, will disappoint. And that's critical. I think that type of diversification is something that people need to do a lot of research on. But just buying 15 equity managers or 15 equity investments as a diversification strategy is not going to result in return. I think diversification's got to be value-based, and you've got to have percentage or indicators on which you increase that asset allocation portion. So I believe in diversification, strategic diversification, not just darts thrown in so many directions with a hope strategy. So again, detailed planning.
That's great. I wanted to share. It's not a slide for this week, but what we're going to talk about at the breakfast is actually, Garth's already mentioned the book Unshakable, and we are going to talk around some some of the principles that have come out from Ray Dalio around diversification, asymmetric risk reward, etc. So we will go into this in more detail at the breakfast. So just coming back to the next question, for me,
just before you move on, just jump back one slide
to the Ray Dalio one, or which one?
Yeah, to the Ray Dalio. Yeah, just back to the book there you've got. Can you go back one?
Hang on.
I don't want to see
that one.
Yeah, I just want to highlight that attractive assets that don't move in tandem. I think that's what I'm saying. You've got to understand which asset classes move in opposing directions, and I think that's incredibly important. That is where your risk and your volatility is reduced. Sorry.
Yeah. No, perfect. And we'll spend a lot more time talking about this at the breakfast in terms of that detail. So let's go. This is a complicated one, Garth, and quite frankly, I've played in the space now myself. I did my first offshore property in 1999, and played in the space trying to help other people since 2004. And one of the things that I've never been able to really get right is around the sort of the offshore tax structuring, etc. I personally have set up four separate structures, and every time I do it, the person who tells me up front says, "Oh, it's wonderful and it's going to work and everything," and then it just ends up being endless cost. And some advice my uncle gave me many years ago is he said, "Listen, don't spend all your money setting up structures to save on tax. Focus more on making money." So, what's your thoughts on sort of tax and structuring and offshore structures, and also where the world's going in terms of transparency and if it's even worth it?
Yeah, it's quite a long answer, but I want to deal with a couple of things that people aren't aware of. We come from an environment where people had a lot of structures and things set up to avoid tax. And, when you've pumped $70 trillion of debt into the world, somebody's got to pay that debt. So you had kind of the sweeping up of grey money and everybody having to be linked to a tax number somewhere in the world. And, worldwide taxation came in. So the simple answer is there might be tax efficiencies that protect you for the next 5 to 10 years. And when I say tax efficiencies, I'm not talking about good, clean structuring that can minimize your tax. I'm talking about tax havens are gone. If you live in a country and your money's in a tax haven, you're going to pay tax. And I think that there's almost a desperate time where fundamentals are changing around structuring. But for me, one focus remains, and that is you can plan for estate transfer, legacy planning, and you can plan very, very systematically around the buying and selling of portfolios. And that comes down to capital gains in various forms. To make it simple, you want to be in a position where you make opportunity decisions, not tax decisions. So as we move into a world where data and governments and tax authorities pretty much have access to all records and will get exposure to that, you can't skate close to the wind on anything related to tax evasions. Those days are gone, thankfully, because we need to see this transfer of wealth. So if you've got a tax problem, that's a good thing, because as you said, and then you're making money. If you haven't got a tax problem, you're not making money. And the legacy planning is the more important part, and that's what comes in the multifamily side of things, is how to transfer that wealth. There's a lot of value in structures, but you can understand that there's a very complex, and Scott, when you talk about struggling to get structures together, a lot of it comes in where the USA is involved, and the USA is very complex. So I'm not even going to touch on that. But effectively, plan to grow your wealth in a structure which can pass that wealth on to people. And that's the critical issue. everyday taxations and that, you've got double taxation agreements, which are actually favorable. And there are ways to minimize your tax. And those structures are actually a lot more simple than people think. You want to be seen to be making gains, low tax rate. And that's what people should be sticking to. Not trying to find little islands in the middle of the ocean that they can put their money on. Those days are long gone. The common reporting standard says you're going to pay tax somewhere. And, unless you're able to, flit around the world and never really have a tax presence in any country for longer than 60 days, you're going to need to be tax resident in one country. And then you minimize those taxes through efficient structuring and through investment holdings that are efficient. But there's way too many complex opinions out there that nobody can unravel. And, like 10 minutes after setting it up, you can't even see it. You can't even understand it anymore. So keep it simple is a great principle, and stay away from very complex structures. They don't work anymore.
Yeah, I must admit, I'll tell you a funny story just quickly for that, if people haven't heard it before. Many years ago, I had a very expensive structure and a very cheaper structure from a company called One Tax. And anyway, I set it up with a company from One Tax, but what I didn't realize was that the guy in One Tax was the one in One Tax. And when he disappeared, to this day, my house is in a trust, and he's the guy who set it up or whatever. And it's this ongoing mission. So again, also just be careful of who you deal with. Sometimes if you pay peanuts, you get monkeys, and I definitely got a monkey many years ago.
Yeah, I think also, somebody who you can give the brief properly, you can understand your brief properly. I think that's the critical thing. A client goes to an attorney somewhere in the world and he says, I need this structure. He spends thousands of dollars on the structure, but it never serves his needs. Often a person has a very simple need. I want to grow my wealth, and this is the income I need to derive. And then all you have to decide is, how is that person going to derive that structure, and how is the growth going to be protected and preserved? And that's where it becomes critical. People need to be able to make opportunity decisions and not tax decisions. And that's where people lose sight of the structures. Structures are incredibly important. The people that set up those structures and the team that you have must understand what you're trying to achieve. Once you know what you want to achieve, then you can get somebody to put that structure together. But often the two sides of the party, the practitioner and the attorney, for example, don't speak to each other. So it's easy to get a lot of advice. It's very hard to get an effective structure down on paper. So you've got to have somebody that can unravel that mess for you. But they are important, but there's just not that many loopholes left.
Yeah, no, 100%. And that's what I like about, what you talk about, which is having the sort of the cohesive view, not just trying to sort of sell your structure, if that makes sense. Let's move on to, sorry, after you.
No, Kieran.
No, I was just going to say, let's move on to emerging economies. The one thing that you said to me is that, Scott, I'm not interested in getting on a webinar to have a South Africa bashing session, and I completely agree with you on that. But what I am fascinated about is, emerging economies. You have spoken a little bit about them, when we were talking about balanced portfolios. But, a lot of people that are on this call, we've got members in 133 countries. There are a lot of people that are from the likes of China, India, South Africa, etc. What are your take on emerging economies, South Africa included, and where they're going in the next few years? I found this graph, on today when I was searching and preparing for this webinar, which I just found quite interesting in terms of predicted growth of different emerging economies.
Is that GDP, or what is the figure?
You can see it down the bottom there in the right hand side. It says 2019 GDP growth forecast. I mean, look, it's not. I mean, it's at the end of the day, I was just looking for some interesting information for the thing. I'm more interested from your perspective as to what you see happening with emerging economies and South Africa and others.
Yeah, look, I think emerging markets have been actually discounted for a very, very long period now. They came off a very high base where we had this super cycle in commodities, and that pushed them really, really high up. So emerging markets for me, from a cyclical point of view, I mean, if I take a forward look at economies, I think you'll see the US demographics pushing the economy down, and I think you're going to struggle to continue to deliver the returns that we've seen coming out of the US, for example. I think one of the biggest things influencing emerging markets right now is the trade wars. And I think that's a high risk to emerging markets and creating a lot of, emerging markets volatility. And I just don't think emerging markets can be crucified forever. I mean, they've really, like South Africa, has been flat for close on 5 to 6 years. You look at GDP, it pushed into recessionary territory. It came out of that in 2016, and it actually, practically started pushing up. We had a lot of, corruption issues in the government at that point, and it still yielded a decent positive cash return. I mean, I'll give you an example, not to go on about South Africa, but over the last 3 years, effectively your rand appreciation, your currency has remained flat. So I'm warning a lot of people not to, commit suicide by running out of weak emerging market currencies to buy hard currencies. So why I say that is because there was a contagion, and Turkey got hit, and that created a downturn in most of the emerging market economies. So people flooding out of emerging market economies are buying a very expensive dollar, and they're selling a very weak currency. So when you look at emerging markets, I mean, there's strong discounts. You look at the Shanghai, it's discounted by a comfortable 20 to 24%. And that discount can't continue forever. So forward looking, I mean, you can see up to 2029 even. I think you'll see a lot of returns coming out of the emerging markets. But it's volatile. So it's not something you want to take a switch of like 80% that you had in the US and now you put 80% in the emerging markets, because there's quite a lot of volatility. And a lot of portfolios can't sustain that volatility. Global warming, food production, demographic growth, there's theories around the world maxing out at around 11 billion, and a massive amount of that, growth is going to happen in Africa. I think, Africa, India, Asia is declining in demographics. But when you look at that, it's also becoming a wealth shift. So food productions, users of technology, there's a lot of simplicity in cell phone and smartphones and technology that can be put out to that massive demographic that's growing. So I think there's going to be a hell of a lot of money made in businesses out of emerging markets. The cyclical side of shifting from the developed markets and late cycle developed markets back to emerging markets, is going to happen. That search for yield that saved countries like South Africa in the crisis in 2008, that can repeat. We expect another 25 basis point cut to happen, and that's coming from the Fed. So, we see billions flowing into South Africa, which strengthens the economy. But we're definitely late cycle on the dollar. The dollar is expensive against most currencies. It can spike, but it's got to go back to a mean average. So I just think, that's one of the risks that we have, and I think that's one of the the problems that people are seeing. I think the move to emerging markets, the commodity cycle will pick up again. But I think, countries like China, for example, has built an economy on a lot of debt, and servicing of debt is going to be a problem. So I think a lot of fixed investment, genuine growth in the economies is overdue. So let's see what happens. But I personally think emerging markets got a very bright future running right up to 2029.
So for a company that's focusing on the emerging middle class in Africa, India, and China, you would think that's quite a good thing.
No, I don't think they've had access to the investments, and I don't think they've had access to the technology. And I think if you look at the US, it's constricting. It's difficult. You look at the trade wars. I mean, it's not possible to go back to the manufacturing and the industrial capitalism that built America. That's not practical, because unemployment in America is like 3%. I mean, nobody's going to do those jobs, and even those jobs, if you do internalize that again, you're going to see most of that done by robotics. So we've got to look at how jobs are going to be created. So that's why I think the emerging markets have got such a bright future, and they're coming off a very low base, extremely low base at the moment. So those GDP numbers that you have there can be very, very different going forward.
Oh, it's exciting. And for those of you who don't know, we've our team in China is growing from strength to strength, and we're actually looking to get going in India at the moment, we've got partners on the ground and are working actively with them. So tell me, Garth, from your perspective, in terms of the global economy, you know, a lot of people around the world are talking about things like recessions, global crisis, global correction, you know, et cetera, et cetera. You've mentioned a few things like the trade wars, you know, et cetera. Where do you see the global economy over the next, couple of years in terms of, you know, they always talk cyclicals, 8 to 10 years, et cetera. You know, what are your thoughts, and what are you sort of, what's your gut telling? What are you preparing other people for, et cetera?
You know, factually, you know, for me, global growth is slowing down. I don't think we've got a cataclysmic crash on our hands. And when we talk about a recession, you know, we're not talking about a subprime crisis. We haven't got a bubble of that magnitude. But there are very real risks to, you know, to global companies and the global economy. I think I want to touch on a couple of very interesting things there. I mean, climate change, for example, and how businesses operate. When we look at the investors of the future and we take 10 to 15-year views, you know, people are not going to tolerate profit at the expense of the planet anymore, because we're in trouble. And, you know, we can deny climate change and things like that, but it's going to affect food production, and that's going to affect economies. It's going to affect agricultural classes. You know, water shortages, all of these things are opportunities, but also going to affect economies, and they're going to affect businesses. So I think, you know, if you take industries like tobacco industries and that, I think they'll come under pressure in the traditional cycle. And if I look at the global economy in a recession, I think there's a definite slowdown coming. You know, we touched on the 2 and the 10-year yield inversion curves, and not to get complicated, but those often preclude, you know, are the precursor to a recession. What people don't see is how long and what happens from that yield curve inversion, and it's actually back above and it's flattened. What you've got to realize about a recession is it can often happen 2 years after that signal. And I think there's still a late stage return coming. I do think there's 15% from all-time highs that can still be earned. But I think people are going to be very cautious, and this is where, you know, talking to portfolio construction becomes very important. You know, you can be patient right now, but you've got to have at least 5 years of capital that's not exposed if you're in retirement phase. Wealthy individuals, you know, we're pushing those portfolios to up to 5 years, and that's critical, because you're not going to time the market. We all know that. If you try and time the market, you're going to get hurt every time. You're going to sell on the down cycle, and it's going to turn so fast. And I mean, if you just take November, December, the market went down nearly 15% over 3 or 4 days, and in 4 or 5 days, you know, it went back up in the January, February period. So this end of the year cycle, the sort of November, December, January, February period, over the last 5 years has become incredibly volatile. And now that we're back at all-time highs, I mean, we you know, getting close to record territories again. So I'm very, very cautious. And that's because I believe that the world isn't about to crash, but it's got massive volatility. I think there's a couple of things to understand here. One, your future investors are not going to be tolerant of profit at all costs. Wealth transference is going to be critical. There's an upsurgence in more of a socialistic approach to wealth, and that's going to affect countries like the US. I don't think wealth can be contained in the hands of so few for the future. I think you're going to see things in the future coming in, like super taxes on the wealthy, to diversify that wealth into global growth and to stimulate the economy. It can't be contained like that. So these are changes that we're going to see in the global economy. These are changes that people need to prepare for. But, you know, things like climate change, people don't realize what a realistic threat that is to markets and how businesses operate and how businesses are going to profit. So I think it's a time of caution. I don't think we're going to see, or we have the threats in the market of a massive crash. I say be careful of anything that's got an acronym, because if it's got an acronym, it's really in the focus. So you've got to be careful of these multiples that are right up in the hundreds. And markets are relatively expensive, and I think they are stretched. And I think healthy corrections will be part of the next 2 years. And how people react to those healthy corrections is what's going to determine whether we end up with a greater recession happening. And the problem with that, and this is what I want to caution people against, is if that picks up momentum, people start selling frantically. The problem is that, when 2008 happened, you had interest rates up in the 5, 6s, 6.5. So the monetary policy, the governments had something they could play with. They could push these interest rates down, and that could stimulate the economy. So we've got a risk of seeing very, very different mechanisms playing out. You can't print more money and push that into the market. We know that is an end stage cycle. We've got very high levels of debt. So I think cautious portfolios that have got 5-year, 10-year views and patient capital where you're deriving rental incomes, deriving good dividends, more defensive portfolios like that are critical over the next, I would say, 18 to 24 months to see how this whole thing plays out, how the trade war plays out, how Brexit plays out. These are significant risks to the global economy right now. If those settle down and we have then more momentum, then we can start setting targets of going back into the market. But I've got to exercise caution, and I've got to talk to that caution because even politically, we've seen things like Arab Spring. I mean, you look at Hong Kong recently. People are not tolerating it anymore, and I think the Democrats and the Republicans, for example, are way more divided than ever. And I think politics and this fight between capitalism and socialism over the next 10 years is going to be a very, very powerful theme, and it's going to have massive effects on how countries operate. And if we don't see the collaboration and people pulling together to solve a recession, if it happens, we're going to have a real problem. And at the moment we've got trade wars. And if we have this cyclical thing that pushes into a recession, the world's got to work together. Otherwise, we're going to have real problems. That's where we can see a much bigger event happening than what the market's fundamentals really dictate should happen.
A couple of comments to that. I had dinner with the South African Reserve Bank last night and the regulator, as I said, and I was sitting with one of the top guys, and it's quite interesting. There's actually 40 regulators around the world that have monthly meetings on exactly what you were talking about, on the fact that they can't drop interest rates, and so what do they do? So it's interesting, the regulators, 40 of them from around the world, are collaborating to try and solve that. The other thing I wanted to show was what you were talking about with the inverted yield curve. There is an article, and I've actually put it in the chat box for everyone, which explains it in more detail in terms of what Garth was talking about. And I'm not going to go into it in detail, but it's just one of many articles. But I did put that in the chat box for people to be able to go and look at. And the third thing I wanted to say was I'm reading a very good book at the moment called Thank You for Being Late. And I can't even remember who wrote it. But anyway, it's called Thank You for Being Late. And it's really interesting because this is more of a medium to long-term view of what you're talking about. And it actually leads quite well into the next, the second last question, basically around, risks and opportunities, because it was talking about how things are accelerating and change is accelerating so fast, not always in a good way, sometimes in a bad way. And I mean, you spoke about climate change, you spoke about economies changing, regulators changing, technology changing, social changes, and they're all happening so fast now at this exponential rate, and they're all converging as well, which is creating so much uncertainty for people. And you've already actually sort of alluded to this question around a lot of the risks that are out there for people, and equally where some of the opportunities lie. Without repeating yourself, Garth, is there anything else that you would add? I mean, you have spoken quite a lot already about the risks, so I don't want to repeat it, but anything else that you think would be of value here? And again, I found two interesting little graphs today when I was preparing.
Okay, yeah, I need to put my glasses on to read those. I can't see what they're saying, but look, I think I'm not going to talk more about the risks, but let's talk more about the opportunity side there. Look, I think the world is understanding that there's a massive connectivity economy developing, and what I mean by that is how people are working together and how people are looking back towards themselves, wellness, dealing with issues like obesity, all of these type of things. So I think a lot of opportunities lie still remain in the wellness sector, and I think in the connectivity economies, and that's a massive opportunity for me. So it's one of the areas that I believe like a lot of the technology is focusing on. So I think there's great opportunities in that sector. Agricultural, because of climate change, I think there's great opportunities in clever farming practices, in harnessing water in effective methods, in not 10 billion square kilometers of farming as opposed to clever farming practices. And I think this is where the risks will prevent opportunities as well. And I think that's one of the main areas that's also very good. Food production, we know that that's never going to be never going to be something that we get a grasp on that. Sorry, I'm just reading something else here that was put in front of me. I mean, everything comes with a price. So I think adopting early technologies is risky, what I spoke about with the 3D printer. So that's a risk I think people should be careful of, and that they should understand what they're investing in. I don't think you should touch anything you don't understand. That's a risk. There's so many opportunities. The world's moving so fast that people are jumping into these technologies without understanding them. And most of the successful technologies are things that solve very simple problems. So I always say to people, don't jump into technologies and future opportunities and into things you don't understand. Even these, all the greatest opportunities that are presenting still require the same fundamentals of business. They've got to solve a problem. People have got to buy it, and they've got to have a margin. And that's why I say some are so sophisticated that you can't understand these things. I think that's critical. I think people must be very, very careful of, the news that goes out there, and just understand the fundamentals for themselves. It's not doom and gloom, and the opportunities do exist. There's a lot of like mid-cap companies, mining sectors and stuff that have been suppressed for so long. So yeah, those opportunities exist. I don't want to go into the macroeconomic risks again.
So my last question, I'm conscious of time, so my last question, I'm actually going to put it together, which is sort of 2020 and beyond, and the key things you need to succeed, and then equally, going into the next decade and why it's important. Let's put those two questions together and conclude with them. What do you see, and it really ties together with a lot of what you've already answered. But if you were to take, you've got hundreds of people that are on this webinar tonight. What are some of the key things that you think people need to do to prepare themselves to not only be successful going into the next decade, but also, I mean, we literally are a month and, 2 months away now from this next decade, and every decade has had such measurable change for all of us in our lives. What do you think people should be doing and looking at a personal level so that they can, not only survive, but thrive going into the next decade?
Sure. So on a macro level, I think one of the things that's going to put a lot of pressure on the next decade is the retirement of the baby boomers and the cost of that. I think people should be aware. But preparation, personally, I think people understanding what and how the world's going to look in the next decade is critical, and building a plan around that with proper collaboration with the right partners. I think that's critical. The next decade and the emerging market upsurgence, which I think will contribute massively to that, and the technology changes. I think people need to equip themselves physically and certainly electronically and tech savvy, and understanding how if you're not in the game, you won't understand it. You've got to be able to process information. You've got to be able to understand what big data means and how that comes in. So preparing for that. Understanding how climate change will happen in the next 10 years, to touch on that again, I think that's going to be one of the most influential factors. And, getting equipped for that from an investment portfolio point of view and from a company. There's no point in buying a value trap. What I mean by that is you see a discount, but you don't understand where the world is moving in the next 10 years. So you buy this deep value, this discounted company, but it's got no future in the next 10 years. So understanding those trends, understanding companies that will fit into those trends. And what I mean by that is companies that are going to appeal to the investor, investments that are going to appeal to the investor, not you know, going to be that of the massive capitalization and the wealth creators of the past. You know, the blockchain technologies, the ability to build quick businesses. And, you know, also to understand the biggest risk that we've created over the last 10 years that's going to come home to roost in the next 10 years. And that is the debt trap that's been, you know, set up. I mean, huge amounts of cheap debt have gone out there, and that's a risk. And there's big emerging market debts and defaults on debts can alter the playing ground. So, you know, I think people should be understanding technology opportunities slowly. I think people should be spending time on webinars like this, understanding where the momentum is, understanding where the shifts are, but also not just jumping into something because it sounds fantastic. If you don't understand its execution, you don't understand how it's going to be, you know, disseminated into profit, you've got a real problem coming your way. So, yeah, I mean, that's just touching on the, you know, the next 10 years ahead of us.
Awesome, Garth. Well, I really appreciate you know, all the time that you've shared with us. I just want to, there are some questions, but I just wanted to quickly pivot. You know, I always say to people, you know, you've spoken about, you know, right now coming on webinars, learning from other people. You know, I believe it's nature's principles that literally, you know, a bird flying on its own versus a bird flying in a flock. A bird can fly 70% further, you know, in a flock than it can actually on its own. And it's one of the reasons that we put together these breakfasts, because quite frankly, I got so irritated in South Africa with all the negativity and people being concerned about their futures and everything else. And we said, well, why don't we go back to our basics and do what we've done for more than a decade and put together breakfasts. We'll bring in, you know, people like, you know, yourself and Hilda, myself, and actually empower people, give them access to education, give them access to opportunities. And so these breakfasts are being held, like I said, in Durban on the 12th of November, Cape Town on the 13th of November, Johannesburg on the 14th, and Pretoria on the 15th. You can actually go to the web link here, which let me just bring it up quickly. Oh, sorry, I'm going to get the right one. There it is there. So it's Wealth Migrate online /Wealth 5.0. I will put this quickly in the chat box if Lee hasn't done it.
Already.
Oh, she has already. Okay. Thanks very much, Lee. And but for those of you that are watching the recording, you can literally go online. You can see all about it, what you'll get in terms of all the different speakers, etc. And really, for me, you know, in session one, we'll be looking at the 12 most important things you need to know about investing, how to manage risk, preserve and grow your capital, how to diversify, which countries are the best, how do you get wealth preservation, a plan B and peace of mind, the impact of currency, foreign passports and becoming a global citizen, you know, the right to be able to set yourself up and find the right partners, the best sectors based on the data, you know, what are the fundamentals saying, how you can get started from $1,000, what are the major trends, you know, how you can have the freedom to be able to set yourself up, and also what the top 1% are doing. And there's many other things that we'll be talking about, like tonight. We spoke about the secrets of wealth and diversification and what Ray Dalio and everything are doing. Then after breakfast, what we'll do is we're actually going to have a Q&A session where between Hilda and Garth, we're going to continue going deeper into the global economy, what wealthy people are doing, what risks, you know, where is South Africa, you know, what are these balanced portfolios, how do we build economically resilient structures within global markets, you know, immigrating, planning, you know, what are experts looking at for the next decade. But it's not a canned presentation, it's a conversation. And so if people want to come along and be part of the conversation, you know, it's really a fantastic session for, you know, for people to be able to do that. And we will be looking at some of the bonus sessions. I'll be alluding further to Wealth 5.0 and, you know, how one can not only survive going into the next decade, but how one can actually thrive in terms of that whole principle. And then what we'll do, just for the people that come to the VIP lunch, we're actually introducing our different partners. We've got partners coming out from England. RB Care Homes are actually coming out. You know, they're providing a 10% cash on cash return, which is really amazing. We've got other partners, including Chad Pope and their Cashbox. We've got some of the immigration partners coming. So really, it'll be an opportunity for people to meet and you know, shake hands with the partners and understand them far better. In terms of the tickets, for the silver ticket, people can come along to the breakfast. For the gold ticket, that actually gets you included in the VIP lunch, and everyone will get access to the wealth pack. I know someone was asking earlier, and we will be sending out the intro pack to everyone by the end of this week. And then we also had quite a few people that have asked for one-to-one sessions. I I know God said, for people that are wanting to build their portfolio, etc. Calio obviously deals with high net worth families in terms of, people that are wanting to build that portfolio, people that are wanting to have one-to-ones with myself and or with Hilda. They will be able to set up a one-to-one session. It will be an online session that'll happen either before or after the event. But just to confirm, it's definitely online. There won't be time on the day to be able to do it. And that will be for people that do a platinum ticket and actually want to be able to deal with people directly and really get the answers that they're looking for. Just in terms of the prices, we do everything in dollars because we think of ourselves as global citizens. But what is important is that there is a discount until the 31st of October. So I'm not actually sure what day that is. I think it's Thursday when the discount closes out. So if you're online tonight or you're watching the recording, make sure you take advantage of this. No point in paying extra money, and then it'll go to full price from the 1st of November in terms of that process. And then we got the Wealth Weekend. This, for me, as I said to you right at the beginning of this webinar, is where we go much deeper. We take away the theory, and there's that thing from Deepak Chopra that if you want to do something in life and you do it on your own, you've got a less than 50% chance of succeeding. If you do it with a partner or a friend, you've got about a 60% chance of succeeding. But if you do it in a like-minded group of people or a mastermind, you've got a higher than 70% chance of succeeding. And what Hilda's going to be doing is taking people on a deep immersion session over a day and a half, where people will walk away, will actually have the plans in place, so that you can really thrive going into 2020. It is our Wealth Weekend. It's where we invite all our wealth partners who are shareholders and our top VIPs to the weekend. It's one of our most, it's one of the ones that I enjoy most of the entire year. It is actually only for our wealth partners and VIPs, although what we have got is 20 spaces which are available for people that aren't wealth partners. And that'll, basically you would just need to apply, it's by invite only to be able to come and be part of that very special weekend in terms of that process. And so the question I've got for all of you as we go into, just checking if there's any other questions, is what are you doing to be a global citizen? And more importantly, are you ready for 2020? I know Garth was saying, earlier before this webinar, and I repeated the exact same thing. I'm feeling quite tired. This has been a long year. We're getting to the end of October. And, for many South Africans, there's only sort of a month to 6 weeks to go until the holidays. But the question is, what are you doing to be ready for 2020? And this is such a unique opportunity to get people ready so that they can, get the information, get the knowledge, even take action so that they can really start next year and the decade strong. And, for those of you that want to go a lot deeper, we do have our investor strategy sheets. If you're interested, just type in the investor strategy sheet, or if you want one of our team to get hold of you, actually just put your number in. So just put your cell phone number. It's much easier for Alex or myself or one of the team members if your name is there with your number in the chat box, and they can get hold of you. We can send you the investor strategy sheet. You would have seen that I've been asking polls, through the evening. And what's interesting is that, your time is valuable, so is our time. And the more information you give us, the more we can personalize and help you personalize your journey in terms of that process. And so you can see the next steps there. You've got the different website links that Lee has already posted. So I wanted to just check here quickly. I'm very conscious of the time. Garth has answered the questions in so much detail that I just don't want to take too much more of your time, Garth. But I wanted to see very quickly if there was anything. The book names and everything, I think we've answered, and I'll summarize them at the end. Where can I find out more info about the breakfast? So Claudia, we would have put the link, and you can see the link is on the screen. And if you're watching the recording, you can click down below, and there'll be a link to it below the recording. I've missed the previous webinars. How can I access them? So again, that is on this page. Let me go to it quickly. It's on. Sorry, that's actually the page all about the masterclass. Sorry, I forgot to show you this page. All around the masterclass. So I'll actually put the masterclass page also in the chat box, just so that you got it. Sorry, I apologize. I actually forgot to put that up. And then Lee's already done it. Lee's so much cleverer than me. Sorry, Lee, he really done that. Fantastic. So what were we looking for? That's the Wealth Pack. So this is the link here in terms of the Wealth 5.0 webinar series, and we have put that in. And otherwise, just ask the team, and they can make sure they send it to you. I can see people have put their numbers in so that people can get hold of them directly. I need to run, so thank you very much. Thank you, Garth. Really appreciate it. A number of people have put their numbers in. So, Garth, I think you've actually answered everyone's questions in a huge amount of detail. So, I just wanted to say a huge amount of thanks from our side. It is late on a Tuesday evening for you, and really appreciate all the information that you shared with everyone. And as always, to Lee, thank you so much for setting this up and getting it all working for everybody. It's so wonderful to be able to share so much valuable information with people. I've learned so much from tonight's webinar series.
Well, thank you, Lee. Thank you for setting it up, and yeah, absolute pleasure to chat to everybody. And yeah, I look forward to the workshops where we can be a little bit more focused and not deal with such a massive subject in one evening. But yeah, I hope people have got value out of it, and look forward to chatting further.
Awesome. I always try and sum it up. Sorry, Lee, after you.
I was going to say, I think that's one of the trademarks of our webinars, Garth, is that we pile so much valuable information and content into it. So thank you very much for your time, and for everyone who's been online. It has been a really powerful webinar this week. So thanks everyone for joining us.
Well, I always try and sum up what I take away, and this is maybe a lesson for everyone else, because I'm not telling you what to do. I do it myself. I take notes, and I took notes all through what you were presenting tonight, and I keep these notes because I find them very valuable to learn. And some of the things you said tonight that I took away, which were huge value of what is a family office. They're just like you've got an architect of a home, they're an architect of your finances. It's about protecting and preserving, and about collaboration. I loved what you said about entrepreneurs are not great investors, and it's the difference between Warren Buffett and Richard Branson. And there's a lot of changes now in behavioral finance. There's a lot of consciousness around behavioral finance. Habits are being a lot more controlled, and mood swings. One of your jobs is to help with the mood swings as markets go up and down. We've been flooded with opportunities and cheap debt, but it is important for people to have the correct structures and time frames, and to make sure they're putting square pegs in square holes. And then I loved what you said, stay the course and have a clear focus. You said with a balanced portfolio, the rules have changed since 2008, and now you need to understand individually what someone's purchasing power is, or what your own purchasing power is, so that you can sustain your lifestyle and also sustain the volatility within the markets. And one of the things you spoke a lot about was the psychology of money and wealth. Under books, for those of you who didn't get it, it was Ben Colston, The Wealth of Common Sense, and it's all around the principles of averages and understanding the playing fields, and also snowball effect from Warren Buffett. Property, you said that every wealthy person that you've met has a significant portfolio of property. It's a complex asset class. It's underpinned by dividends and rental incomes, which is very valuable, but you need to be careful when, to understand all the intricacies, the demographics, etc. And what you love about property is that people never actually sell when it's a down market. You said diversification. You need to be careful of diversification to death. There's a fine line between diversification and throwing darts. And you said, I love that. And it's important to be strategic. When it comes to tax and structuring, you need to look at tax efficiencies, because over the next 5 to 10 years, they'll be dwindling, and it becomes much more about legacy planning and transfer of value, and the structure must be more about passing it on. And then when it comes to emerging markets, you said, generally they've been crucified. Somewhere like South Africa has been flat for 5 to 6 years. The Rand has been flat for 3 years. But over the next 10 years, its emerging economies, will have a lot of opportunity, but will also be volatile. And things like global warming, food, population growth, there'll be a lot of money to be made within those emerging markets for business. And then, yeah, in terms of the global economy, we're definitely going to be seeing a slowdown. It is a time of caution. We need to all think about how people react to the corrections, and it's important to look at cautious portfolios and patient investments with yield, which I found very interesting. One of the things that we've looked at in terms of our investment committee is looking more at only income producing assets versus new developments. And then lastly, under opportunities, you spoke about having a connectivity economy, and then also being careful of early technology unless you understand them. And I love what you said, Joe, around the principles of business, solving simple problems, make sure that people want to buy it and that there's a margin. And finally, under success in terms of going into the future, retirement of the baby boomers, emerging market changes, technology changes, people need to be able to process information and prepare for it, and be careful of the debt trap. And I don't know if that's an exhaustive list, but that's the list of highlights that I took away from the knowledge that you shared tonight. So thank you very much. It's been absolutely wonderful.
I don't think a top PA could have taken notes that well.
I was a bit of a diligent.
If crashes, I'll give you a job.
Well, Scott's very good at taking notes, but not so good at returning emails or answering phones. So I wouldn't hire him just yet, Scott.
All right, so no, it's been a wonderful summary of things that were said there. Yeah, I hope we can delve into those in very specific areas, but absolutely fantastic being able to share, guys.
Awesome, and to remind everyone, this webinar was about freedom of choice, and I know Hilda was actually online tonight. This is a poem that Hilda put together, which I always remind everyone it's really should be our big driving why, and it's imagine a world where most or all people are literate, a world where education is par for the course, a world where women are treated as equals, a world where all people have access to investment opportunities. Imagine a world where 6 billion people on this planet who currently live in poverty can live a better life. Imagine that world. At the Wealth Movement, we're aiming to create that world. And the breakfast events and the Wealth Weekend is all part of our bigger picture purpose. And everyone that will be joining us will be participating and driving forward to one of the things that our community is driving, which is entrepreneurship amongst children. There's this young gentleman called Bongi that we've crowdfunded and put him through a private school. And I tend to joke with people, there's a good chance he could be the next Elon Musk of this world. And so everyone that's coming to the breakfast and or the weekend will be contributing to not only people like Bongi, but other parts of the Wealth Movement as we continue to drive it forward. And so thank you to everyone tonight. Garth, it's wonderful. Lee, it's been wonderful. To all of you that have been online, it has been absolutely wonderful. Next weekend, believe it or not, or next week, sorry, next Wednesday is WealthE Wednesday. Remember, the first Wednesday of every month, we drop the minimum investment so that you can participate on the platform. We will have a learning session. And then literally the week after that, we'll go into the investor breakfast. Please do me a favor. If you enjoyed these series and you got value out of them, please share them with your family and friends. There's not often that you're going to get an opportunity to interact face-to-face with someone like Garth. Hilda's flying out from America. I'm going to be flying around the country. We've got partners flying out from England, from America, and from Australia. This is a unique opportunity for people to take control of their destinies as we go into that next decade. And so, please join us, but more importantly, also tell your family and friends, I'm tired of South Africans whinging. And most importantly, if you are South African, hold thumbs for the weekend. If you're not South African, hold thumbs for South Africa this weekend that we beat England at the World Cup. That's my closing comment with me in a South African t-shirt. Good night, everyone.
Good night, everyone. Thanks for joining us.